Puri, MD of UTI Asset Management. He joins us on the sidelines of the ICICI US conference to talk about the markets which are extending themselves out and seeing unabated rally. Mr. Puri, great to have you on the show. Thanks very much for taking out the time. Are Indian markets looking expensive or fair in terms of valuations? I know we are going past 20 times one-year forward earnings, but the market doesn't seem to be bothered.
At this point, I think the market is, it's on a strong foundation, but it is fairly valued. I think, as you know, it is around 23 times earnings at this point. So a little bit above its median, maybe half a standard deviation or so. And in addition, the mid-cap index is also trading at quite a high premium, around, I think, 31, 32 times. So it's a big gap between the general index and mid-cap. So it's certainly a time for retail investors in particular to evaluate their risk appetite, their holdings, and see whether they need to do any rebalancing. Certainly not a time to panic at all, but for those who feel that their needs have been met or that perhaps the risk is a little high for them, there are opportunities to look at balanced or debt funds and to essentially do a little bit of rotation. But really, I'd underscore that there's no need for panic at all. But this is a market on good foundations, but certainly quite well valued.
Mr. Puri, afternoon now. Indian mutual funds, including yours, I'm sure, are sitting on elevated cash levels right now. So what's the strategy? How are you coping with the liquidity flow?
Sure, yeah. No, I think it's, so first of all, it's obviously good news that flows have been steady, domestic flows, and both HNI and retail flows have been quite steady. And as you know, there's 4,500 crores of SIPs now coming in every month, which is a very welcome phenomenon. 40% plus of total flows are coming through that mechanism now. So it's a steady support to the market. On the deployment, I think yes, clearly managers have to be highly selective about stocks that they're going to buy in a market such as this. And generally, there's a tendency to stay away from sectoral or thematic approaches at this stage. I think it would also help if there was a step up in primary market issuance. And one question here is, of course, the government will try and sell some of its PSUs, but you really need a lot more good quality companies to come to the market. And you also need the regulator to take a good look at the free float and the listing requirements, because there are many companies that are still listed well below 25% of free float. And if the equity market is going to develop in a healthy fashion, we do need much more liquidity. And I would certainly consider reassessing whether A, the 25% limit is in fact too low in terms of listing requirement, and B, whether those who have not complied with it should be encouraged to do so immediately. We absolutely need a good supply of stock in the market to ensure the long-term growth is sustainable.
And at what stage of the market cycle are we in right now? Because clearly we've moved up from deep value, but in terms of the stage that we're at, do you think we are in the mid-cycle already?
Yeah, first of all, I'd agree with your implication that markets are cyclical. I think there's a tendency when markets are going up for people to assume that we are in some kind of linear movement, and that is obviously unrealistic. We are still in an industry where you will see market cycles. I think that's a very important observation. At this point, it's a little, hard to judge whether we are at a point where the market has peaked or is at sort of maturity and so on. Because one, there are fairly good foundations at this stage. The market is expecting maybe 22-23% CAGR in earnings of a fairly low base. So a lot is going to depend on what we see materialize in terms of earnings expectations. The last 2 years we've been disappointed, where we set off with 15 to 20% earnings expectations and of course achieved much less for 2 consecutive years. But now the base is lower and there is this expectation that we will finally start to see the 20% plus earnings growth, and that's a critical factor for determining where the market is at this point. The second is that we are in a world with excessive liquidity. That's a truism at this point in time. And until such time as that liquidity is withdrawn, there is difficulty in understanding how this market will retrace in a meaningful way, because liquidity is clearly a very strong support for the market. So a combination of reasonable expectations on fundamentals and strong liquidity mean that it may be premature to sort of call this as a market peak at this point. That would be my assessment. But as I said earlier, it does come down to individual risk appetites as to the extent of exposure that they wish to have at different points in the cycle. And I would certainly say that for retail investors, it is always worthwhile to actually consider individual asset allocation relative to their own obligations and risk appetite. I don't think it's a one-size-fits-all where you can say this is the time to buy as a general statement or this is the time to sell as a general statement. If you have holding capacity and a high risk appetite, certainly it's absolutely the right time to not just hold but keep investing given the fundamentals and liquidity. But if you're in a different situation, it's very much a time for rebalancing given that you will have got full value or fair value for the holdings that you have.
Right, earnings growth will, do you think it'll get more broad-based from here? I mean, and not segmental, so to speak. Start of the year is always good, but somehow we're not able to catch up and dwindle in the second half.
That is the expectation, but I don't think you can take anything for granted. The factors underlying that, of course, are sustained commitment to economic reforms or revival of rural demand post monsoons, the flow through of some of the stimulus resulting from higher pay settlements as well, which will again boost consumer demand, and continued FDI and government spending to boost capex, maybe followed perhaps by private sector capex, which has been the missing element in this whole process. So there are a lot of assumptions there, and I would not go so far as to say there's any certainty about this. I think the factors are reasonably supportive, but this is something that we really need to watch very closely, and that's our job, is to consistently and carefully watch this in a fact-based way. We can't get carried away. Our job is not to be cheerleaders. Our job is to be responsible fiduciaries who handle our clients' money in the most responsible way, and we have to be quite clinical and unsentimental about that, frankly, in my opinion. And that's our job. Right. So we take nothing for granted, but certainly we are encouraged by the underlying foundation at this point.
Right, and what are the queries from India, Mr. Puri, from financial institutions, US fund managers, global fund managers, because the India exposure as part of the global index is still sub 1%.
I'd say there's three sets of issues that seem to be emerging. One, of course, people continue to be quite absorbed by the political dynamic in India. There's a lot of curiosity around what the agenda is of the government and to what extent it's being carried out. So a lot of focus on the political economy of India, given the outcomes of state elections and so on. Generally, expectations are positive, but people are still seeking to fully understand the elements of this reform process, which is underway. Second is a desire to really get to grips with the facts and details around specific reforms in specific sectors. So, what really is the impact so far of reforms carried out, for example, in the power sector, in the banking sector, where is that leading us? A lot of curiosity and probing around the on-the-ground impact of these shifts. And then, of course, discussion around critical fiscal and macro reforms. GST, of course, being in the forefront of people's minds. And that's clearly viewed as a very positive and a big success. But people are also trying to ascertain that whether or not the effects of demonetization have indeed fully worn off. So these are some of the themes. I would stress that overall the sentiment towards India does appear to be very positive, actually, at this point in time. So these are all questions that are being discussed. And of course, I have been providing as best I can perspectives and answers on these. But overall, positive sentiment, I would expect to see continued allocation and flows from global investors.
And finally, Mr. Puri, what exactly is your prediction for the markets? What is the script of the market, according to you, over the next 2 to 3 years?
Yeah, so I actually think our markets are in the process of deepening and maturing. So the strength, as I said, is going to lie ultimately in good earnings, improvements in corporate governance, underpinned by continued reforms, which will obviously provide macro support to the markets. And I think there's some high probability of all of these things happening. I think we have achieved a higher reputation for corporate governance, particularly post-Satyam, which has helped our markets a lot. I already discussed the earnings outlook. And I think there is a lot of conviction, or I would say a lot of belief, that the government's commitments to reforms are indeed something that will be carried out. There's a willingness to give a certain amount of benefit of the doubt. But of course, having said that, investors anywhere in the world always want to see impact. And in the medium to long term, they're going to judge impact, not intent. Now, assuming that the follow-through and impact comes about, which I certainly hope will be the case, we have perhaps one of the better supported markets, certainly one of the best among any emerging markets. And therefore, I see us as continuing to be a leader rather than a laggard in terms of attracting flows globally. And domestic conviction remains very high, and with relative yields being now fairly poor in other asset classes and continued shift from real estate, gold into financial assets, I do think both equity and fixed income markets will be beneficiaries from this. How that allocation will happen will depend on people's risk appetite. But generally, this will be a good time for deepening, broadening India's capital markets over the next 3 or 4 years.
Thanks, Mr. Puri, for that ET Now exclusive conversation.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.